Welcome to The Explainer. Have you ever wondered who's really pulling the strings when it comes to the interest rate on your car loan? Or why the price of, well, everything seems to be on a roller coaster? Today, we're going to pull back the curtain on the powerful and often invisible world of central banks and their monetary policy. All right, so here's how we're going to tackle this. First, we'll get a handle on the one concept that's key to everything, liquidity. Then, we'll see its dangerous dark side. Yep, we're talking inflation, and meet the master tools central banks use to keep it in check. After that, we'll connect the dots directly to your wallet. And finally, we'll see how this whole playbook is changing for the future. Okay, first things first, we have to understand the lifeblood of the economy, something economists call liquidity. Now, I know it sounds like a super fancy financial term, but I promise you already get this intuitively. It's all around us, from the cash in your pocket to the very house you live in. So let's do a little thought experiment. Imagine you need to buy some groceries, like right now. You've got 3 assets on hand: a wad of cash, a solid gold bar, and the deed to your house. So which one are you going to use to pay for your milk and eggs at the checkout? Yeah, it's a no-brainer, right? Cash is the clear winner. You can just hand it over, the transaction is done in seconds. It's the ultimate tool for buying things immediately. It is perfectly liquid. Now, gold, it's definitely valuable, but you can't just slap a gold bar on the counter. There's an extra step. You've got to find someone to buy it, agree on the price, turn it into cash, and then you can spend it. It's not nearly as fast. In house, forget about it. That's the toughest one by a long shot. Selling a property means finding a buyer, dealing with mountains of paperwork. It takes a ton of time. Super valuable, sure, but totally useless if you need to buy something on the spot. And that, my friends, is the whole idea behind liquidity. It's not about how much something is worth, it's about how fast you can turn it into spendable cash. So cash is the king of liquidity, while a house, for all its value, is one of the least liquid things you can own. Okay, so if liquidity just means easy to spend cash, why wouldn't we want as much of it as possible? Sounds pretty good, right? Well, here's the twist. Central bankers are obsessed with this because, believe it or not, too much cash in the system is actually a really dangerous thing. You see, it's a pretty simple cause and effect. When there's a lot of cash, a lot of liquidity flowing through the economy, people and businesses just have more money to spend. And what do? They spend it. This drives up demand for absolutely everything, from cars to houses to coffee. And here's the big catch. When everybody wants to buy more stuff than is actually available, sellers start to realize they can charge more. And they do. This big, widespread price hike is exactly what we all feel as inflation. This is where our main character enters the story, the central bank. You can think of its core mission as being the thermostat for the economy. It's constantly trying to control the flow of money, that liquidity we talked about, to keep prices stable and stop inflation from spiraling out of control. So how on earth do they do that? Well, let's pop the hood and look at the 2 main tools in their toolkit. These are designed to do one of 2 things, either pump money into the economy or suck it right back out. First up, we've got the repo rate. The easiest way to think about this is like a lending window that the central bank opens up for all the other banks. When your bank needs some quick cash, it can borrow from the central bank, and the repo rate is the interest it has to pay. This is the main tap for pouring money into the system. But what if you have the opposite problem? What if the banks are just swimming in extra cash? They're lending it out left and right, so much so that it's fueling that inflation we want to avoid. How does the central bank hit the brakes? This is where things get really clever. The central bank basically makes an offer to the commercial banks. It says, hey, you've got all that extra cash just sitting there? Why don't you park it with us for a while? Get it out of the system. We won't just keep it safe for you, we'll actually pay you interest on it. And that's the crucial difference. The repo rate is the accelerator. It's the tap that lets money flow into the banking system to encourage lending. The reverse repo rate is the brake. It's the drain that pulls excess money out to discourage lending. 2 sides of the same coin used to fine-tune the whole economy. Now, I know this all might seem like some high-level game played between giant banks, but these decisions have a very real, very direct impact on your personal finances, especially anytime you need a loan. This little chain reaction right here shows you exactly how it hits home. Step 1, the central bank raises the repo rate to fight inflation. Okay, step 2, suddenly it gets more expensive for your bank to borrow money. Step 3, what does your bank do? Well, to protect their profits, they pass that extra cost on to you, the customer. And the final result, the interest rates on your car loan, your home loan, your business loan, they all go up. That's the direct connection. But here's the thing. The economy never stands still. It's constantly throwing new curveballs, from financial crises to global pandemics. And because of that, the central bank's toolkit has to keep evolving too. Take the COVID pandemic, for example. The usual short-term loans just weren't cutting it. So central banks rolled out new tools, like long-term and even targeted repo operations. These gave banks access to money for up to 3 years, sometimes with a catch. They had to lend that money to specific parts of the economy that were really struggling. And on the money-absorbing side, things have gotten really innovative. There's a newer tool called the Standing Deposit Facility, or SDF, and it's a major upgrade. You see, with the old reverse repo, the central bank had to give banks government bonds as a kind of security deposit. With the SDF, no security deposit is needed. Now, that might sound like a tiny detail, but it means the central bank can absorb almost unlimited amounts of cash from the system. It gives them way more power and flexibility. So at the end of the day, central banks are in this constant, high-stakes balancing act, always creating new tools to tame the economic beast. And that leaves us with a really big question for the future. In a world that keeps getting more and more unpredictable, is this evolving toolkit going to be enough to keep our financial world stable? The answer to that affects every single one of us.